Don't wait to buy your gold after there's tariffs. That's the worst time to buy it. It's going to be tough, you know. So if you want to have physical possession of gold and silver, buy it now, not only because the price is going to go up, but because the tariffs may go on. And of course, the gold producers are not going to eat those tariffs. Tariffs for sure will go dollar for dollar. So if Trump imposes 25% tariffs on gold, any gold coming into this country is going to be marked up by $25. Otherwise, it won't come in, because nobody in Russia is going to sell gold to America for $1 less than they can sell it in Europe, right? The price is the price.
With Trump's tariff threats shaking global trade, gold dealers are rushing to move bullion from London to New York, capitalizing on price gaps caused by looming restrictions. The Wall Street Journal reports that gold futures in New York have surged 11% this year, nearing $3,000 an ounce, while London prices lag by nearly $20 per troy ounce. This price gap has triggered a transatlantic gold rush, with major banks like JPMorgan and HSBC transporting massive amounts of bullion to the U.S. to sell at a premium. With fears that tariffs could soon apply to gold, dealers scramble to avoid the potential cost increase, securing their inventories before new trade barriers drive higher prices. The U.S. already ranks as the fifth largest gold producer globally, but domestic supply won't be enough to meet rising demand, making imports crucial, yet far more expensive if tariffs take effect. U.S. gold inventories have skyrocketed as demand rises, while London faces shortages and delayed deliveries. Some analysts estimate the U.S. now holds over $106 billion in gold, more than doubling since Trump's election, as hedge funds and banks race to stockpile precious metals. Meanwhile, delivery times for bullion in London have stretched from days to weeks, highlighting the strain on supply as gold rapidly shifts across the Atlantic. With Trump's aggressive trade policies already imposing 25% tariffs on steel and aluminum, speculation is mounting that gold could be next. This uncertainty has driven up borrowing costs for gold, as investors rush to lock in positions before any tariff-related shockwave hits the market. Economist and gold advocate Peter Schiff warns that waiting could result in paying significantly more. If tariffs are imposed, the additional cost will be passed on to consumers, making imported gold and silver much more expensive than in Europe. Schiff also notes that silver premiums could rise, especially for imported bullion, as domestic supply struggles to keep up with demand. As large investors rush to secure their metals, Schiff advises those looking to protect their wealth to act now. He emphasizes that rising global uncertainty and inflation are already pushing prices up, and buying now will help avoid paying a premium when supply tightens further. We present the clips of Peter Schiff's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Friday was also a very interesting day, because when I woke up Friday morning, silver was up over $1. Silver was at like $33, $33 and like 30 cents, 40 cents. And so it looked like a real breakout, except the problem was it was only silver. Gold was only up about $4 or $5. So when I saw that, I was, it was a little iffy. And I thought, maybe there's just a lot of unwinding of these spreads, because a lot of people, I think, have been long gold and short silver as a spread, thinking that, look, if gold goes down, silver will go down more. And if gold goes up, it's been going up more because the ratio has been moving in that direction. So rather than just being long gold, I'll be long gold and short silver. And in case the market goes down, I can make money that way too. But I think that it's been so stretched where the ratio has been more than 90-1. I was talking about this on the last couple of podcasts. I've been telling people, look, buy silver. And I still think that you should be buying silver over gold right now, right? Even though I'm a gold bug, silver is really cheap in terms of gold. And so it looked like we were getting a unwinding of that spread. And I think that's what happened. But then as gold started to go down, it cascaded, and gold went to down $45, and silver went from up $1.10 to unchanged. right? I think it ended up the day flat. Now, it still was a gain in gold versus silver in recent times. If gold was down $45, silver would have been down $1, maybe more. Instead, it was flat. So I think there was some unwinding going on throughout the day, but that unwind caused gold to go down. People start getting bullish on silver. It's because gold and silver are going up. I think it's a much stronger bull market when you have silver leading the way. And I think maybe we're going to be entering that. So at this point, with silver still trading around $32 and gold, near, it's 2,900, even though it dropped $45, it's still barely below 2,900. In fact, it's up, it's up $13 right now on Sunday night. So it's just $28.95. We're only $5 below 2,900. Silver should already be above $50, given where gold is at a minimum. So for now, I would focus on it, and especially with the tariffs looming. There's been articles written, and it's happening. They're not just writing the articles; they're writing about what's going on. But a lot of gold has been coming into the United States. A lot of it coming in from London, and the reason I think you're seeing a rush of imports is to get ahead of these tariffs, because the tariffs would apply to gold. And a lot of the gold that Americans might want to buy is going to be imported. America produces gold. We're the fifth largest gold producer in the world. Number one is China, right? They're pretty much number one in everything. Number two is Russia. Number three is Australia. Number four is Canada. And then the United States. If gold demand really picks up, which it should, we won't be able to meet it with our domestic production. And so we're going to need imports. Well, if there's a 25% tariff, who's going to want to pay 25% more for their gold? So the idea is, let's bring the gold into the country now so that we don't have to import it. Well, I would suggest the same thing for our customers at Schiff Gold, right? Don't wait to buy your gold after there's tariffs. That's the worst time to buy it. It's going to be tough. So if you want to have physical possession of gold and silver, buy it now, not only because the price is going to go up, but because the tariffs may go on. And of course, the gold producers are not going to eat those tariffs. Tariffs for sure will go dollar for dollar. So if Trump imposes 25% tariffs on gold, any gold coming into this country is going to be marked up by $25. Otherwise, it won't come in, because nobody in Russia is going to sell gold to America for $1 less than they can sell it in Europe, right? The price is the price. And so if we want to tax Americans $25 to buy Russian gold, then they're going to pay $25, 25% more than what the Europeans are paying for the same gold. So the idea is to buy it now. And the same would be true with silver. Now, I guess if you're buying like junk silver, obviously that's not imported, but that's, when you're buying junk silver, that's a used product, right? By definition, right? You're buying it from somebody who's selling it. But if there's a 25% tariff on silver coming in, that's going to cause a big premium in junk silver, because people buying junk silver, or anybody who's buying, a used silver product that's already in this country, right? They're going to be able to charge more, because it's not going to be competing with the new products that are being imported into the country. So the big guys, the institutions, are trying to jump ahead, and they're buying their metal now. I would suggest that, my followers, customers, Schiff Gold, do the same thing, except more so with silver, right? Buy your silver now. Maybe there'll never be tariffs. Well, it's still cheap. You should buy it anyway. Even if you didn't have the threat of tariffs that were going to make physical gold and silver a lot more expensive, you'd want to buy it anyway. So now you got another reason, right? You can kill two birds with one stone. You can get into silver before the price goes up, and you can beat the tariffs. And if it turns out there are never tariffs, well, then you still did the right thing by buying it. And the fact that we did get this sell-off, it may have been off to the races on Friday. After it was up $1, maybe it would have gone up 2 or 3, and who knows? The fact that it came down, that's a good thing. if you want to buy some silver.
The gold advocate has sounded the alarm over the skyrocketing U.S. budget deficit, which hit a staggering $711 billion for the first quarter of the new fiscal year. This marks the highest deficit ever recorded in a quarter, surpassing even the dire fiscal conditions during the COVID-19 pandemic. Despite the claims of a robust economy, Schiff argues that the ballooning deficit reveals a deeper, underlying issue, what he describes as a stealth recession. He points to the extraordinary fiscal stimulus measures taken by the government, which he believes have masked the true state of the economy. In 2023 alone, the U.S. spent a record $1.13 trillion on interest payments on the national debt, surpassing spending on national defense, and the situation is expected to worsen in the coming years. Schiff warns that interest payments on the national debt could hit a jaw-dropping $2 trillion annually by 2026, further straining the nation's finances and making debt payments the largest budget item. Schiff's concerns point to a growing financial crisis that the U.S. government is not fully addressing. Despite potential cuts in discretionary spending, the massive national debt ensures that the U.S. will continue to run large deficits driven by the cost of servicing this debt. With over $1.2 trillion borrowed annually to cover interest, the situation is unlikely to improve. Schiff stresses that no cuts to waste or fraud can resolve the crisis. Without a shift in policy, the U.S. will face a future where interest payments surpass critical programs like Social Security and Medicare. He also underscores the importance of turning to tangible assets like gold and silver as a hedge against the economic instability caused by the growing deficit. Let's get back to the video.
We actually got the first quarter of the new fiscal year completed. So we have 3 months of the fiscal year. And the deficit in 3 months, the official deficit, was $711 billion. That's a record. So we've never had a quarter where we have had a budget deficit that large, including during COVID. Amazingly. So, supposedly the economy was really strong in the last quarter. So we have such a strong economy. Why do we have the biggest deficit in any quarter in history? I mean, normally, if the economy is strong, the deficits are smaller. They get bigger when you're in a recession and they're doing all this stimulus. What that proves is that we were in a recession. We were getting stimulus. And I pointed out that the fiscal stimulus that we've been getting has been the most that we've ever had. There's massive fiscal stimulus because this is a stealth recession that nobody has acknowledged. The voters acknowledged it by sending Kamala packing and electing Donald Trump and the Doge boys to go to Washington. But that's a 40% increase, too, for the first quarter of the prior fiscal year. Also, last year, fiscal 2023, we spent $1.13 trillion on interest. I mean, by far a record, which we're going to beat this fiscal year. But more than we spent in national defense. The only program that's more expensive than interest on the national debt is Social Security. And that's going to change. I think by next year, we'll be spending more on interest on the national debt than we spend on Social Security. And then we'll be spending more on interest on the national debt than we spend on Medicare and Medicaid combined. It's going to be the number one line item in the budget, and there's no stopping it. Think about it this way. I mean, right now, I'm sure we're doing $100 billion a month, at least, in interest on the debt. $100 billion a month. What that means is that the interest on the debt, because, of course, we're running a budget deficit, and so we have to borrow the money to pay that interest. It's not like we got the money. So the interest on the debt, the money to pay that interest, has to be borrowed, just like a lot of other money is borrowed. So we have to borrow another $1.2 trillion a year to pay the interest on what we've already borrowed. So the interest on the debt alone adds $1.2 trillion a year to the debt. Now, we never even had a $1 trillion budget deficit until recently, right? Until, was it COVID? Or when did we have our first $1 trillion? It just happened. Now we're going to have $1 trillion deficit every year, even if the budget is balanced, right? Even if the government balanced the underlying budget, meaning we paid for everything that we spend except interest on the debt. Just interest on the debt would give us $1.2 trillion deficit. So in other words, we need a $1.2 trillion a year surplus to break even. That's how deep this hole is. But we're still digging it because it's not going to stop at 1.2 trillion. And I think by the end of 2026, we'll be spending $2 trillion a year on interest on the national debt. So, I mean, this is a catastrophe happening right before our eyes. And I know as the Republicans are trying to negotiate a new budget, yes, getting rid of waste, fraud, and abuse is going to help, but it ain't going to cut it. It's not going to solve the problem. It may mitigate it somewhat. And I think part of the good that we're going to get is a public relations good by exposing the fraud and corruption.
As gold dealers rush to ship valuable bars from London to New York, they are betting that the price gap will continue to widen in the short term due to looming tariffs and President Trump's trade policies. With tariffs potentially increasing the cost of gold in the US, dealers are quickly moving their bullion to capitalize on lower prices in London before they rise. This scramble to fill New York's vaults reflects immediate price differences and the growing expectation that tariffs will push US prices higher. As the supply in London dwindles and demand surges in New York, gold prices could soar, with analysts predicting they may soon exceed $3,000 an ounce. With the supply imbalance intensifying, it is crucial for those looking to secure gold at current prices before they skyrocket even further. Share your thoughts on Schiff's analysis in the comment section below. If you find this video informative, don't forget to support your finance log team and turn on notifications to stay informed about our latest videos. See you in the next video.